How's it going, everyone? I want to welcome you to a brand new lecture in the 2025 Trading Protocol series, where in this lecture, we're going to discuss the final step in the higher time frame protocol, which is point of interest. Now, a point of interest is the final step in the higher time frame protocol because once that point of interest is reached, we then immediately drop to the lower time frame and then look for our lower time frame protocol to play out. And so without further ado, let's get into today's lecture. So just to recap what we've done so far, our first step in the higher time frame protocol was to identify order flow, and the way we identify order flow is through expansions and retracements. Bullish order flow, price will expand higher, retrace lower, expand higher, retrace lower. How do we know whether order flow will continue being bullish? Well, we need to identify a drawn liquidity, because if we have a drawn liquidity that is higher, then we know that order flow will continue towards that drawn liquidity. Now, knowing the drawn liquidity is higher and knowing that order flow is bullish, we know that order flow is likely to continue towards that drawn liquidity in the form of another expansion leg higher. But where's that expansion leg going to form? Well, it's going to form at our point of interest, our POI. The reason why this is important is because if we know the drawn liquidity, and we know the drawn liquidity is higher, and we know our point of interest, we know our point of interest is below current price, all we have to do is wait for price to reach our point of interest, drop to the lower time frame, confirm that this is actually a reversal on the lower time frame, and then trade towards our drawn liquidity. It's really as simple as that. Now, on the other hand, let's assume order flow is bearish, where price expanding lower, retracing higher. Again, we need to know the drawn liquidity, and we need to know that the drawn liquidity is below current price, because then we know that price will likely continue towards that drawn liquidity, producing another expansion leg lower. And we need to know the point of interest, because this is where that expansion lower is going to originate, meaning once our point of interest is reached on the higher time frame, what we can then do is drop to the lower time frame, confirm that this is actually a reversal, and then trade towards our drawn liquidity. Now, price moving from point of interest to drawn liquidity is what we call narrative. Now, what do I mean by this? Well, the narrative is that price will go from point A to point B, from price level A to price level B, from point of interest to drawn liquidity. Without knowing the point of interest and without knowing the drawn liquidity, we cannot frame a trade idea on the lower time frame. Why? Well, because if we're trading market maker models and we know that every higher time frame retracement lower followed by expansion higher is a lower time frame market maker buy model, we cannot know where that retracement will end and that expansion will begin without knowing the point of interest. Not only that, we cannot know whether price will continue higher, meaning we can continue to frame a market maker buy model if we don't know the drawn liquidity. And so in other words, without the drawn liquidity and without the POI, we cannot frame a setup. There's no narrative here, there's no story. However, if we identify the point of interest and we identify the drawn liquidity, all we need to do is wait for the point of interest to be reached and then drop to the lower time frame and then trade towards our drawn liquidity. But just to summarize, if we know order flow is bullish and we know the drawn liquidity is higher, we need to wait for our point of interest to be reached to then trade towards that drawn liquidity to frame that lower time frame market maker model. Now you might be wondering, okay, well, how do we frame our point of interest? What is our POI? Now I want you to remember the order flow lecture where we discussed invalidations. Whenever order flow is bullish, there's going to be a discount array that cannot be violated. And that discount array has to be utilized as support if returned to. And so if I just draw this out, when we talked about order flow, we said, okay, well, in bullish order flow, let's say price expanding higher, retracing lower, there's going to be a discount array. The way we utilize or identify order flow, again, is utilizing the left side of the curve. So if this is the right side of the curve, there would be a left side of the curve. We're going to have a discount array that is our invalidation level. That discount array, that invalidation level, is always your point of interest. Why? Well, think about it. Let's say we know the drawn liquidity is higher. So let's just say this is our drawn liquidity. Well, if we know order flow is bullish and we know the drawn liquidity is higher, we know that that drawn liquidity will be reached as long as price does not displace below the low ends of this box, the low end of the discount array. Meaning, if price returns to this point of interest, it has to be utilized as support. And if it has to be utilized as support, then what's likely to occur next? Expansion higher into the drawn liquidity. And so in other words, our point of interest is going to be our invalidation level. Now, the reason why this is important is because your analysis now is going to become much simpler. On your chart, you're going to have two price levels. Your first price level is, of course, going to be the drawn liquidity. Where is price drawing towards? The second price level or price range you're going to have on your chart is your point of interest. All you need to do is wait for your point of interest to be reached, then you drop to the lower time frame, and then once that reversal is confirmed on the lower time frame, you trade towards that drawn liquidity. It really is as simple as that. And so this is exactly how we identify points of interest. You'll hear me a lot of the time say, this array must be utilized as support, or this array must be utilized as resistance. What I'm saying is, if price is going to continue towards the drawn liquidity, price has to utilize it as support or resistance. Meaning that array is our point of interest, because if price returns to it, again, it has to be utilized as support or resistance. Now, if we apply this to the charts, what we're going to do is we're going to begin after this huge expansion leg lower, because this was post Trump speech, so we had this huge expansion leg lower. Now, all I'm going to do is I'm going to draw in the invalidation level. We're not going to discuss drawn liquidity here. We're just going to follow order flow. So what we can see is this is the left side of the curve, this is the buy program, and this is the right side of the curve, the sell program. Change in the state of delivery occurred once price displaces below this low here. Why? Well, because then this entire range here would become a bearish breaker. You can even utilize the entire range from the retracement lower to the expansion higher. This entire range would become a bearish breaker, where we had a high, low, higher high, lower low. What I can also see is we've displaced below this range here. So from this high to this low, notice how many times this be utilized as supports, important price range. This is now the invalidation for the current sell program. Now, if I look below that, what I can also see is we have this bullish order block here. Now, this bullish order block right now is a discount array because it's below current price. If price is placed below this discount array, this would then become the new invalidation for the sell program. Meaning for now, if we were looking for shorts, if price retraced into this price range here, we can then drop to the lower time frame and then look for a market maker sell model. Price is now closed below this price range here. This now becomes the new invalidation level, and this is now our POI. Because remember, our invalidation level is always going to be our point of interest. If we continue, price then retraces into that point of interest. Remember, on the lower time frame, this is original consolidation, left side of the curve, smart money reversal, right side of the curve. So within our time of interest or session of interest, we then drop to lower time frame. But what we do know is that this is a potential market maker sell model that is unfolding right now. So if we play price out, price has now formed a potential high, and then price completes the sell model. So we had retracement higher, expansion lower. And so this here was the market maker sell model. And so assuming your drawn liquidity was lower, and you correctly identified the invalidation, which again is your point of interest, what you could have done during London, this is 4 AM here, drop to lower time frame, apply the lower time frame protocol, and then trade this market maker sell model. Now what we can see is that there's no arrays on the left side of the curve that we can refer to. And so this forces me to use arrays that formed on the right side of the curve. And I'm just going to make this a different color to showcase this was a sell model. And so this was a market maker sell model you could have traded. Now what I can see as well is that price is now displaced below this low. Why is this low important? Well, this is Wednesday's low. This is a previous day low. Price is now displaced below it. And so this entire candle here, which is now the previous day low, is our invalidation. And this invalidation is our point of interest. Price retraces into it. Remember, we know this is just the buy side of the curve of a future market maker sell model. So this moment here, you drop to lower time frame and apply the lower time frame protocol. And then boom, the second sell model completes. So if we now continue, and so what I can now see is we have this imbalance here that displaced below this low. This here would now be a balanced price range. If you remember, we have an equal amount of buy side and sell side delivery. which has been displaced below with an imbalance. This is now a BPR. And so the imbalance that displaces below the low must be utilized as resistance. And so our point of interest and invalidation level now will be this imbalance here. Price retraces higher into it. You now drop to lower time frame. And what we can see is another market maker sell model. Notice how all of these sell models have formed at our point of interest, and our point of interest is our invalidation level. If we continue, what I can now see, same again, we have this low here that was displaced below with an imbalance. This imbalance now becomes important. And so as long as price remains below this imbalance, we can anticipate the sell program continuing. Price is now retraced into it, potentially forming a high, and is now beginning an expansion lower. So we have a new market maker sell model that we could have traded. And so I'm just going to number these just so we can keep track. That was number 1, that was number 2, that was number 3, and that is number 4. Let's continue. Remember, this is all occurring within the space of a few days, from Wednesday to Friday. If we continue, we now have a new huge imbalance that is formed. And again, I have to utilize the right side of the curve here. I can't refer to the left. And so this imbalance now becomes my invalidation level. And so as long as price remains below this imbalance, it must be utilized as resistance. Price now retrace into it. Again, as long as price does not invalidate the high of the imbalance, we know that this is just the buy side of the curve of a market maker sell model. Boom. Price completes the sell model. So we had retracement higher, expansion lower. And so this is sell model number 5 that we could have traded. And again, our point of interest was also our invalidation for the sell program. We continue. And now this is current price. And so in total, just based on the hourly time frame, utilizing as a higher time frame, we had 1, 2, 3, 4, 5 market maker sell models that we could have traded in this entire expansion leg lower. And our point of interest was always our invalidation level. What I'm now going to do is I'm going to look at some of the execution videos that I've taken. And what you're going to see is that my point of interest, so the box that I'm going to have highlighted, is always the invalidation for the sell program. Every single time on that hourly time frame. Now what we can see, if you remember, this is my most recent trade. This was this imbalance here, where price retraced higher and expanded lower. This is that same imbalance here. And I utilized this as my point of interest. Once price reached the point of interest, I then dropped to lower time frame and then applied the lower time frame protocol. So what I could see is that order flow is bearish, my drawn liquidity was lower, and price had reached my point of interest, and this point of interest is where I dropped to lower time frame. If we look at the next example, what we can see is we had these consecutive imbalances here. This imbalance, and this new week opening gap combines, utilized as resistance multiple times. And so I said, as long as price remains above this price range here, the buy program is valid, meaning this point of interest is also my invalidation level. And so I'm anticipating retracement lower, expansion higher. And if we take a look, we can see that price reaches our target. If we look at the next example, what we can see is I have these consecutive imbalances here that have been highlighted. As long as price remains below this price range here, order flow is bearish, and my drawn liquidity is 19,900, meaning I anticipate retracement higher, expansion lower, and so my point of interest is also my invalidation level, meaning once price reaches the invalidation level, I drop to lower time frame and then apply the lower time frame protocol and enter the trades short. We're going to look at a couple more examples. I'm just going to prove to you that every single trade I take, my point of interest is also my invalidation level. So we have this bearish order block here that was displaced above on the right side of the curve, left side of the curve, right side of the curve, price is displaced above it. And so now it must be utilized as support. And so once price closes above it and then retraces into it, I then drop to lower time frame and then frame a market maker buy model into my drawn liquidity. And so again, my invalidation level is also my point of interest. We'll do a couple more examples now. What we can see is we had this imbalance here. This is a 4-hour bearish for value gap. And I said as long as price remains below this price range here, order flow is bearish, and this in time move high is a retracement, which is going to be followed by an expansion lower. Not only that, we have this expansion lower, retracement higher, expansion lower, meaning I'm anticipating this in time move high to be a retracement. And so my POI is this 4-hour bearish for value gap. And so it cannot be invalidated. It must be utilized as resistance. And that's why I'm seeing retracement higher, expansion lower. Once price reaches it, I drop to lower time frame and then trades this market maker sell model into my draws on liquidity. We will do one final example, but if you want to go to my x.com/JME_MMXM, I'll put the link in the description. Every single execution video you see, where I begin on the higher time frame and drop to lower time frame, you'll see the higher time frame array that I've annotated is my invalidation level, and that invalidation level is also my point of interest. And so in this case, we have this price range here, which is a bearish breaker, where we had a high, low, higher, high, lower, low, price closed below it. And so as long as price remains below this price range here, this entire move high is a retracement, which is going to be followed by an expansion lower. And if we just take a look, price retraces higher, I enter shorts, and then price continues towards my drawn liquidity, and I exit the trades. And so once price reaches my point of interest, I then immediately drop to lower time frame, assuming we're within my session of interest, and then I apply the lower time frame protocol. Once the lower time frame protocol is aligned, I'll then apply the execution protocol. Once the execution protocol is aligned, I will then execute the trades and manage it. So that brings us to the end of this lecture. Point of interest is always your invalidation level based on the time frame you're measuring order flow. And so this will simplify your analysis a lot, because all you have to do is identify, okay, what array would invalidate the current delivery program, annotate it on your charts, annotate the drawn liquidity. Once price reaches your invalidation level, drop to lower time frame, apply the lower time frame protocol, and then take the trades. And so I hope you found some value from this lecture. And with that, I'll see you in the next video. Be safe.